off. Welcome everybody. This is the Thursday evening Viper trading webinar. If you're here to learn about trading the futures markets using the Viper tools, you are absolutely in the right place. First, we got to knock out our standard disclaimer. All communications from Viper Trading Systems are for educational purposes only. Futures and Forex trading does involve risk, and there is a risk of loss. Nothing contained in this webinar, other webinars, including the live trading room, are to be construed as investment or trading advice. And of course, everybody in here does know that you do trade at your own sole discretion. All right, so today's topic, the planned topic anyway, was setting targets and stops. But in the pre-webinar session, in talking with the team here, several folks wanted to talk about the topics of entries, good entries, proper entries, no heat entries, those kinds of things. Let me shift over to screen 1 where I have a YM chart waiting for us. All right, so this is the early session on YM. Pop quiz, make sure everybody's still awake and paying attention here. So in the pre-market session for any chart that we are looking to trade, what is the first thing that we should do? Bonus points to those of you who get this right. This is so important. I think from now on what I'm going to do is ask this question at the beginning of every webinar. What's the first thing we do when we open up our NinjaTrader in the morning? We get our charts all set up, prepare for trading that day. What is the first thing we do? Okay, good. David D, Diane weighing in. Draw our lines of support and resistance. Look to the left to see the trend. Identify the trend. Carl G, draw support and upper. We draw our lines. Good. So in this case here, we would put a line. I'm going to help you out. Hold on a second. Let me take a quick sip of tea. Sorry about that. Yeah, you draw your lines. Now, just a quick side note, and I'm not going to belabor a lot of these points because I've said them hundreds of times in other webinars, is one of the things that's going to help you be successful in the long term as a trader, or in any business for that matter, is consistency. So for me, I am a stickler about doing things the same way every time. Very rarely, unless it's warranted, do I deviate from what I'm doing. Okay? So, you know, that's I think one of the most challenging, just as a quick side note for this, okay? That's one of the challenging things for pretty much every trader out there, is to develop that consistency, because without some kind of form and structure, it's easy to get sideways in trading because you're kind of, you know, I don't want to say a lone ranger on your own, but, you know, you have to get some procedures set up for yourself and follow those procedures every day. So, you know, if you wake up in the morning and you're getting ready to trade, or you trade at night, it doesn't matter when you trade. After hours, European session, it doesn't matter when you trade, okay? But just have a consistent pattern that you stick with, and that's the way you approach the market every day. When you have that structure, it's going to really make a huge difference. So what we're saying here specifically is you're going to come in here in the pre-market session before the U.S. equities open. And if you're going to trade any of the equity markets, like that we have in the room, NASDAQ, YM, Russell, even ES, and EMD, any of them, you want to get your support and resistance lines in here first thing. Just takes a few seconds. All right, so here we have, we can see that in the pre-market session that YM is in a trading range. So is this trading range tradable, in your opinion, yes or no? Is this trading range tradable? What's our criteria? This is another thing I do all the time, almost every webinar. Everybody should have this drilled into their heads. Yes, it's about a 30 tick, 25, 30 tick range, plus or minus a few ticks, depending on where you measure it from and to. More or less, you can see that it's been in that range pretty much since the late. Let's go. Let me just orient everybody. There's some new people in here. Let me just get a little orientation real quick here. Okay, so here's midnight Pacific time going into this morning. And by the way, let me back up. I'll just take 2 seconds and let everybody kind of settle in, because we're still getting some more people coming in here. What you're looking at here is the Viper indicators on a 4-range chart on YM, which is the mini Dow. It's $5 a tick. We'll look at some other charts in a bit. We'll look at the NASDAQ and crude and some other charts. But basically, they're going to look the same from a sense that we have bar coloration. We have background colors. Excuse me. We have this notion of the bands. We have the middle band, which is this line right here. And we have 4 bands above it and 4 bands below it. Generally speaking, if the market is trending upward, you would have a green background, predominantly blue bars, and you would be stair-stepping up a little bit like you see right here. Although you could make the case in the after-hour session, this is going late into last night Pacific time, California time, this would have been the Asian session. So you can see YM didn't move a whole lot from yesterday late morning all the way into the Asian session, which is late night here going into midnight, and then midnight, of course, going into early morning is what's called the European session. Okay, so all this is morning time, morning trading time for all the Europeans, and so sometimes you get big moves overnight from that European session. Other times it just chops around. In this particular case, you can see YM was pretty much sideways, right? Pretty much sideways. Now, the reason this is important is really twofold. Like we said earlier, you want to have some form and structure to what you're doing. You want to know it's going to drive everything in terms of your thinking of how you're going to approach this. What I'm saying specifically is this, is that as long as this market stays inside of these 2 lines, it is said to be range bound. It is not trending, and you have to decide whether you're going to trade inside the range or not. Our rules are 20 to 25 tick minimum range to get in and out, simply because to enter from the bottom and get out near the top, you have to fade the top and bottom by at least 5 ticks. So if you get much under 20 ticks in a range, there's just no meat there to trade it. Now, many of you, I know we've asked this question 1,000 times, many of you do not particularly like ranges. You prefer trend trades. So who was it said early on, the heat trade? I think that was Kenneth. Was that you? There was a question in the pre-webinar session here about, yeah, I think that was you, Kenneth. Entries, I'd like to look for entries that somehow don't always go against me. And then Carl G followed up quickly and said, let's call that the no heat entry. Hold on 1 second, please. So here, let me address that in a very direct way. There are cases when you trade within a range where you could feel some heat. For instance, going in here, if you'd drawn this line here and you were looking to buy the support area and you were looking to buy here, you had a resting buy order here through OT or however you got it on the chart, and then start to, sometimes it wicks down a little lower. This is where you feel some heat. So let's say you get long on a bar right in here. It hits a resting order you had, say, perhaps in here. Well, you're going to feel some heat as it pulls against you. This is going to be the case often in range-bound trading, because as you can see here, in the top and bottom of the ranges, even though it's fairly well defined, excuse me, there are times when it's going to poke through it up to the upside and the downside. And if you're shorting the top, for instance, and you shorted this line right up here, you might have felt some heat as the market moved against you up here. So if you have to take that, so let me say it this way. There are lots and lots of different types of trades, and we're going to show as many as we can as a company, as a trading company, educational service, Viper, using our tools. But here's the thing. You don't have to take all the trades that we show or teach, and you don't, for that matter, you don't have to take all the ones that are shown in the room. Because, you know, we have traders logged in from literally all over the world, and they're taking all kinds of different trades, right? So we have to be able to speak to the different trade setups. Now, if you come back and you say, well, you know, Charles, I see the fact that we're in a range. I see the fact that it's 30 ticks, you know, plus or minus here. But you know what? I just really, I've always struggled with range-bound trading. Never been able to really get the hang of it. I can't really handle these little drawdowns here when I get in. You know, it drives me crazy, and I never can really time those just right. Well, then if that's you and you've tried it in sim or with real money, and you can't trade the range, then by all means just stay out of the range. Just stay out of it and look for a good setup. You know, if you want to find good setups, then you just have to be patient. Okay, let's move on. So here we go. We're bouncing around in the range here. Here's 5:30 Pacific, so we're still in the pre-market. Equity market's open here at 6:30 Pacific, so we're still within this trading range right here. See it? That's why it's so valuable to have these lines on your charts. You should be able to see this yourself. Now, a word about mid-band boxes when you're in a range. And here again, you've probably heard this 50 times out of me. Here would be a case where you have sort of a very large, I would arguably not a particularly good box for object trader located right at the mid-band. Ask a quick pop question for the team. Would you say this is a pretty good box to trade, yes or no? What do you think? Is this mid-band box, would this be a good box in the pre-5:30 or about an hour before the market opens? You know, you're looking to take some trades, you're up early that morning, maybe you have some commitments, you got to be done early. Is this a box that you would want to set up an object trader and take, this box right here? Okay, good. All right, good. A lot of no's. So here's the deal. Just a quick recap on the whole box idea. By the way, after today's session is recorded. We'll get it up on the web. We'll also post it on YouTube, and then we'll put it on this webinar page that we have tomorrow, and we'll get it up there so everybody can see it. And I will also get some good box, bad box webinars posted. Here's the webinar page, by the way. Just go to our website. The navigational links are in this little sort of bug up here. See it? Scroll down to webinars. We have some of our recordings are public. You can see that this goes back into early May, so it's about a month ago. We're going to update this tomorrow. We'll get tonight's, we'll get Gary's from yesterday, and we'll get like the last week or so. And tomorrow we'll put them all up here so everybody can watch those and get up to speed. Okay, that's where that is. Webinars. But one of the ones that we dedicated, I believe, you can download those videos, David. Yeah, these are all downloadable. In fact, this is actually, this page has little snippets of code that pull these webinar recordings from our YouTube playlist. So what happens is we'll put them on YouTube, put them on the playlist, and then the latest updates are pulled onto this page. So you can either go to our YouTube channel when it's updated, which will be tomorrow, or you can go to this page and it'll pull in the latest ones up here. Okay? That's public for everybody. In the ones that are for subscribers are password protected in the subscriber area. Yeah. So anyway, back to this real quick. We primarily like to use the notion of a mid-band box, a trade type entry, when you're in a trending move, when the market is trending, and we'll look at this in a few minutes, simply because, first of all, the box is just a little too big. Okay, you're looking at a box that's maybe a box around 15 ticks here, plus or minus, maybe even larger. And so when you are in the middle of a range with a box like this, if it does pop out and get a long trade, you can see there's just really there's no meat here. There's not a lot for it to go before it hits a resistance line. Likewise, to the bottom, if it was to break out to the bottom, which it did, it can only go to here, and it quite possibly might bounce right in your face. And so there's just nothing really to get here. So generally speaking, when you're in a range and the mid-band kind of sits right in the middle of it like this here, you know, mid-band box trading is usually not the best approach. You should try to avoid that. Okay. By the way, some people still coming in here. If you're just coming in, don't worry about it. This is recorded. We'll get it up on the web for everybody to see tomorrow. All right, now let's play this out. Here we're coming up on the open of the market. There's 6 o'clock. There's 6:25. There's the open of the market, 6:32, right there. Let's blow this up so we can get a real good look at it. So it's 6:31 Pacific. So we're about a minute or two into the open of the market. What's the first thing that we can notice about what's happening on this chart right here? What jumps to mind as you see this price action right here? What types of trades are we looking for? Are we still in the range? Or has circumstances changed at the open? What types of trades are we looking for based on the change that you see right here on the chart? Shorts. Yeah. Yeah, so for those of you who might be seeing these chart setups for the first time, let me go into a little bit more detail about what you're seeing here. So in the pre-market session, we drew our lines. This was support and resistance. We talked about the range. We avoided this mid-band box, not appropriate in a range where it's in the middle. And then you can see here clearly that we did go ahead and break down through the bottom of that support level of the range. Now, the background turns red. The mid-band and all the bands stair step down, and we are looking to short retracements. This is a concept that I think everybody, the seasoned veterans who've been in these webinars for many months or many years, know that we talk about. We do not buy or sell thrust moves. So what happens when you come out of a range to the upside or to the downside is that generally speaking you're going to get the thrust part of the move, which is this leg right here. By the way, there was a question that came up. I don't know if the trader that asked this question in the live room this morning was asking about the notion of ABC, what an ABC is. This doesn't always happen, but many times when you have retracements, you get this notion of this ABC type movement, which looks more or less like this. A, B, C. I mean, arguably you could say A, B, C, D, E. Sometimes it's a more complex type move. So here we have a situation where it came right up to the mid-band at the open. We have a red background, so we're looking for shorts. We have a nice confluence of things that occurs here in the fact that, let me really blow this up so we can talk about it. Notice where the mid-band is located. It's located where? Right at where the prior support level is, right? So the trade entry here is we are looking to short a rollover at or near the mid-band, which is also just happens to be located where the prior support of the, so we all know the concept. I'll just briefly recap it, is and this doesn't always hold, but very often it does. Support levels turn into become resistance levels, right? Resistance levels, if you were to break to the upside, generally speaking, tend to become support levels. And that's the second reason why these lines are so important is I think we all would agree, it'd be a little more difficult to see this if you didn't have a line here, right? I mean, you might be able to see the mid-band, but it makes it a lot more clear when you have a line because you can clearly see that this was coming out, it broke down here, and you're looking to short a rollover in here. Now, there are a number of different types of entries. There is a simple bar close. I'm not going to get into all the details of Object Trader. I know Gary has entire webinars dedicated to, in fact, this one right there, for those of you who are visiting this week, or anybody for that matter, this is kind of a webinar that Gary did, I don't know, a couple months ago. I think it's like an hour long, and it shows a lot of the tools. It shows Object Trader in great detail. If you've not looked at this, you should watch this. It's going to clear up a lot of the terminology that we use in the room. Anybody and everybody who has not gone through training should definitely watch this, because it's going to tell you a lot about all the Object Trader and the tools and how it works. It's the first one. We always keep it right here, okay, on the webinar page. Anyway, back to this. So you're looking to get in here, and so when we use the term rollover, does everybody know what the term rollover means? We're looking for that to say something to the effect of, the mid-band's up there for observing right at the open or right before the open. I'd look to short a rollover up around that 740 area on YM. So what are we talking about if you hear those words in the room? Well, what we're saying is that here, I'm going to sort of fill in the pieces of what we're not explicitly saying. We have observed the fact that this support level has broken. We're stair-stepping down. The background is red. The bars are red, and we've gone into a downtrending type move. So we're looking for retracements, and generally speaking, we look for retracements to come up somewhere around this area right here. So you might hear a number in the room. I'd like to see it come up around that 740 area. We may be observing the fact that there was a support level here from the bottom of the range from our line on the chart, and the midband happens to be located right there. Right? Everybody see that? So the term around means that it could not quite get there, and sometimes it doesn't. And sometimes it goes a little bit higher, up into here. So a healthy way to look at it is a region or an area around the midband that we're looking to get in. Now, Kenneth, back to your question. This is where you can feel some heat. Because if you say, if it hits 740, I'm just going to short it, well, then there is some risk that it could go higher, yes? And that's where you feel the heat. If you say to yourself, well, I'm going to short a rollover, in other words, I'm looking for a bar rollover, or I'm going to put some kind of a box around this and let it roll over from wherever resistance comes to be, because in real time we don't know exactly where it's going, right? That's the challenge. We don't have a crystal ball. We don't know that it's going to hit its head perfectly at 740. We don't know that. So we have to get kind of close to it. And then the whole idea of the rollover is that when that occurs, when that rollover occurs, we are convinced at that point that the momentum to the downside is now continuing. So let's really blow this up and talk about this entry. Here we see a candle that wicked above 740, and here we see a reversal candle. Now Gary uses this a lot. This is a feature on NOT. It's a bar reversal, which is that bar right there. You could be in conceivably on that bar, and that's a good entry. And your initial stop would be up here, whatever your default of 10 or 12 ticks is. And if you had used a box, if you wait for a candle or two to form and then draw your Object Trader box around it, like maybe that, like that, with a bias to the downside, in this particular case, yes, you would probably be filled on this bar short, either on this one or definitely on that one right there. Now this doesn't always happen, but sometimes it does, where the bar close entry is very close to the box entry. Hold on one second, please. Sorry about that. All right, so does everybody see this entry? Everybody see this entry that we're discussing here on the short side? We know we're looking for shorts. We know we've identified our sweet spot of opportunity is this sort of rectangular box right here around the midband, yes? We use the midband or support resistance level as a reference point for our entry. We use some of the tools. you know, you can use, there's also a line tool that we use, and there's also a array tool. There's various different types of tools. So however whatever method of entry you are short from here, from this rollover. Now, looking at this chart, when you take the trade, where are we going to put our first target? And by the way, if you can, and this is one of the advantages of trading YM or NASDAQ, which is a $5 instrument, right? That means that the risk is half of what the Russell would be at $10 a tick. So you can put 2 contracts on and have the flexibility to take one off at a profit and trail the second one as a runner. Whereas suppose if you put the Russell on for 2, now you're at $20 a tick. So it's twice as much risk, twice as much return, but twice as much risk. You have to factor the risk part in with the return part, yes? So where would our initial target be located? Looking at this chart, and you took your short entry, where are we looking to peel that first one off? Looking at this chart. What's number 1? Anybody? Where's the first target on here? So now we're getting into what the topic of the session was all about. Good. Anybody? Where's your target? Scalp the target for 8 ticks. Okay. I got David D at 16, Jack at 16, a couple of you at 23, a couple of 15s. Okay, so here's how we do this. Can you see at the apex of our thrust move to the downside that we hit a support level here right at this 15? All right? We're entering somewhere up here around 35. We're going to get 33, 35. You would have been filled short right up in here. All right? Generally, your first target, depending on your instrument, is going to be anywhere from 6 to 10 ticks. Now, in this case here, if you're manually moving things around using Object Trader on your chart, and you see that a swing level is located at 15, you're going to want to fade that. Fading is, for those of you that are new, or where you come within a swing level to allow a target to be filled. So in other words, you wouldn't necessarily put the target right on 15. Okay, you're going to want to come inside that a little bit, and you're going to put your target right here. Let's use a round number. Let's say you're going to fade it by 5 ticks, at least 4 or 5 ticks. Come within it, inside of it, to allow it to fill and come and hit that target. What we generally like to do is when that first target is hit, we take our initial 10 or 12 tick stop, depending on what you used in Object Trader, which, let's see, 10 would put you up here at, say, 45 on your initial stop, yes? Once you hit this target here and you take it out, you set the break-even plus on Object Trader to take it within 2 ticks of your entry. So it takes that initial stop and brings it right down into here. 2 ticks behind where you're filled. This way you have what we call a free trade. So in other words, you've gone 6, 8, 10 ticks, 10 ticks at least here. Yeah, you've actually gone more than that. But so that's the other terminology you're going to hear in the live room, is things like you've got your scalper target. So just to clarify for all the new folks visiting, when we say the words you've got your scalper target, that's what we mean. We mean that you've hit, it's moved 6 or 8 ticks and you've got the scalper target. Go ahead and take your stops and get them close to where you got in. And then of course you're going to start trailing your stops on whatever could turn out to be a runner. Now, managing trailing stops, it really depends on how you want to approach it. You can set up Object Trader to automatically manage it for you, and Gary goes into this in the video. So I'm not going to cover that right here. If you want to manually move your stops, there are a couple of things to follow. On here you can see that we have several lines that the price action tends to follow. And I'm going to show them right here. You have the stealth line, which is this line right here, and you have this this outer line right here that's very close to the stealth line. Those little areas between there and the mid-band tend to be pretty good trailing stops. So what I'm saying is that you're going to want to take your trailing stop as it moves in your favor and move it down like that. You know, sometimes I don't go right on the line or right on the stealth. I'll go a little below it. So either, you know, the wick of that candle might got you, or definitely this candle got you out on your runner. So in this case here, it rolled over, you were filled short, whatever tool you used. You got your scalper target right here, because we faded that bottom right there, and we took, which triggered us to get our initial stop down within 2 ticks of our entry. We began to move in our favor. We start to trail the stop down, trail the stop down, trail the stop down, and then one of these bars here, either this one or this one, took it out. Generally speaking, Brian, yes. Once your scalper target is hit, you would move to the, and you can set up OT to automatically do that for you. There's a break-even plus feature in there, and you set the trigger to correspond with your scalper target. So if you set scalper to 6, you set your break-even trigger to 6 with a 2. Generally, I go with like a 2 offset. Okay, it's right in your OT panel. Break-even plus. That's what that's called. So, you know, tie that together. Now, I'm just giving you rule of thumb, okay? You know, you're going to have to look at your instrument. For crude oil, it's going to be a little different. You know, for those of you that trade the Russell, those settings are going to be slightly different. You know, some of you I noticed in the room trade ES. Okay, ES is generally going to be smaller. Like a scalper target on ES might only be 2 or 3 ticks, right? And then you want to get your stop up. You know, a big move for ES, a huge monster move for ES would be 12, 15, 20 ticks. Generally, once ES goes 6 or 8 ticks, you get a retracement. So it's specific to your instrument, and you're in sim, you're going to have to kind of experiment with this a little bit on your chosen instrument. Well, Brian, it really depends. So just real quick, he has asked how many multiple targets do I like to use. It really depends on the circumstances of what's happening and the timing of it. So it's not a thing that's sort of chiseled in stone. I adjust on the fly depending on the market conditions. In the last webinar, and I'll post this from last week, there was a runner, and it was I spoke to this issue. Multiple contracts. There was a couple of webinars, and I'll get these up on the web there so you can watch them. The multiple contract webinar spoke to this. Generally speaking, and I'll just do like a 2-second overview of what it said. If a market is range bound and not trending as it was right here, this is what I would call not a load the boat condition. So I'm not loading up with multiples in here. I might dip the toe with 1 or 2. Okay. Now, at or near the open, or at or near a news event at 7 a.m. Pacific where I'm expecting, or high energy time where I'm expecting good volatility and good movement, I'll go ahead and I'll load it up. In some cases, I'll put 10, 14, 20 contracts on it, a clip. In that case, what I'm doing is I'm peeling them off as the market moves in my favor, and then I'm either looking to re-enter or move the stops. In those cases, yes, I would have multiple targets, Brian, to answer your question. Okay? But you don't have to load 20 up when the market's trending. You could do 3 or 4. The whole idea in the concept of leverage is you don't want to start really leveraging up too many contracts until you have a very high win rate. Your win rate generally should be above 65 to 75%. I've seen it as high as 80 plus, pushing 90%. When you can get your entries correct and your win success rate very high, then and only then would you start to leverage up in an appropriate relationship to the size of your trading account. Don't over leverage yourself, okay? So what I mean by that is this: if you have a modest size trading account, say, you know, in the $5,000 to $10,000 range, you know, you really shouldn't be putting more than on a YM contract, even with a high win rate, more than say 3 or 4 contracts. There's just too much risk, because if you take a 10 or 12 tick hit with 3, 4, 5 contracts, and you get a couple of pops in a row, you're really dinging down the coin too quickly, right? Anyway, everybody understand that? Okay, good. Any questions on that? All right, so here we are. We're at 6:38. We are a little further into the trading session. And what is happening right here? Okay, we had our first trade. Our first trade's done. We got our scalper, we stopped out of our runner, and it's right back where? Right here at the midman. So I see some of you said, okay, go ahead and box it in, and we're looking for shorts, yes? All right, so here we go. Now we're filled short on this bar right here. You know, one of these bars right here, you're filled short. All right, so it would have been like 20, I don't know, 26, maybe something like that. So, you know, depending on the size of your initial stop, 12 ticks I think is the default. You're looking at, I don't know, 38, 39, 40 for your initial stop location. Oops. Right? Oops, where am I? I think I lost my chart for a second. Stand by. Now notice what happens here. You continue to chop around, and then what happens with these two bars right here? You know, if you had a 10 tick stop, it was probably somewhere in here. If you had a 12 tick stop, it might have been somewhere up in here. There's your heat, Kenneth, right? Carl G, the earlier discussion. There's your heat, right? You're filled and the thing's coming against you. In fact, it might actually even have got your stop. So you get a stop out there. So now you're probably, you know, break even, slightly up or slightly down, because you got this trade worked out nicely, yes? And then you got pop for 2 right here. So this is what I was talking about, that concept of leverage. You know, if you're leveraging up here, you've got to have quite a few good runners to make some coin to make up for the pop that you took over here. Now notice what starts to happen here. As we come down, we break down again, you get short again, and then it comes up just shy of that 40 at 38. So it's hard to say, depending on where your stop was. If you re-entered on another break here, you know, came up and fell just shy, it probably didn't get you on the second one, and then you were able to participate in that overall breakdown right there. Now, what's an alternative approach to a situation like this, where we're chopping around in a tight range and you don't want to re-enter here? So some of you may have chosen to just leave this box on, in which case, yeah, you would have been filled short again, yes? And depending on how tight your stop was, it might have got you again, or you might have kept it above that 40 and let it roll, so it didn't get you. What's another approach when a market is doing something like this? Because at the time this is happening, you're saying to yourself, wow, you know, we're really not continuing. This swing right here didn't get all the way to that bottom down there, so we didn't get our scalper target, right? And we're kind of in a range. What's other ways to do it? You could sit on the sidelines, or you could wait till it breaks where? You could short that, right? You say to yourself, well, you know, I don't know if it's going to stay bouncing around in here for the next half an hour. I don't know that. But I can know this. If it takes this out, I'm probably going to at least get down to here where I can at least maybe take a scalper. And then you know, get my stop down tight and then look for the runner, right? Or you could wait for another retracement. You could say, well, you know, I'm going to, if it breaks and runs, then I'll wait for it to pull back again, and then I'll take a trade. So let's see what happens. All right, we did break and we went down to fresh lows. So the trader who was trading this is you had one winner here. You had probably a stop out here. If you'd re-entered here, you did catch the scalper and the runner. There was your scalper, and then there was your runner. And if you trailed your stop, you got out probably down in here somewhere where it took out the stealth in that line right there. You got out right down there. So that was your runner. And if you were the one who waited until that support level was broken, you got your scalper and you got a runner. Does everybody see that? Now, this morning we had news. So we're coming up at 7 o'clock. Does anybody remember what news we had? Everybody, for those of you that are new, most of you know, of course, I'll just show the site real quick. We use Forex Factory for our news. It's a free site, has all the news on it you want related to the financial markets. Actually, we didn't have news until crude oil at 8 o'clock. So here's our news site here that we like to use, Forex Factory. Just a heads up for tomorrow. Okay, so what you're going to notice if you trade these markets is that the equities have come back and now are somewhat strongly correlated to the oil markets. It didn't used to be like that. Oil was sort of its autonomous thing that just came up and went up and down, and didn't really seem to have any direct correlation to the equity markets, although in the past 6 months that's all changed. When the equity markets are going up, generally speaking, the oil's going up and vice versa. There's times when they're decoupled. But tomorrow, for instance, we have this non-farm payroll number. So Friday, we should have a rock and roll day tomorrow. And we also have ISM at 7 o'clock. Now notice what happens here at 7. Right here at 7 o'clock, what happens? We come up, we don't quite get to the mid-band, we can't quite break down, and now we go up this way. So let me ask you this, what's happening now? Okay, what's happening now? Here you are at 7:30, 7:45. What's starting to happen now? Yeah, a trend change. Right. Where did the trend change? Where did the trend change in here, in your opinion? By the way, just a quick heads up, you see how these lines that you put in the pre-market are still coming into play? Everybody see that? See that line? I haven't changed that line since I put it in at the beginning of the webinar, all the way back here. I haven't moved that line at all. That was support at the bottom of the trading range in the pre-market session. This line right here, see it? See, here we are. This is 2.5 hours later, and that line is still in play for not only resistance trades onto the downside, but notice when it comes through it, it comes above the mid-band, that the trading range that we're in above the mid-band, and I remember saying this in the room, the support is just above 15, around 16 to 18, and resistance is up near 40. If you're going to scalp it, it's spent, the better part of a half an hour in this trading range right here. Now, if you were scalping it, and I don't remember if I explicitly said it, but I should have, in the future I will, is that in this condition, your primary mode of entry in this range, if you were trading it, and I did trade it, I wasn't loading the boat, I was dipping the toe, so I wasn't putting 20 in multiples on here, I was just putting a few on here. You're buying support, you're taking profits up here. You're re-entering support, taking profits up here. Re-entering, taking profits, and then the trail starts to kick in, and you start to get a breakout to the upside. Arguably, the trend change occurred more or less in here, but not necessarily from and this is a misnomer that I think a lot of people sometimes have with this notion of trend, is markets don't always go from down to up. A lot of people think, well, it's going to go, if it's not going down, it's got to go up. If it's not going up, it's got to be going down, right? Well, many times, as you can see right here, YM is a good example of this, where you were heading down, and then you went into a transitional sideways period for a while. Yes? Arguably, you were starting to try to head up because you're getting a little bit of a series of kind of higher highs and higher lows, and the background turned green, and your bars are predominantly blue. But right in here, and no question about it, when the market took this swing out, there was no question of the fact that is a trend change right there. Can you see how everything stair-stepped up? All the bands and mid-band stair-step up. We take resistance out, push up to a fresh swing for the session right here, right in here. Fresh swing, taking that out. Background is green, solid green, and now we're looking for longs. This prior resistance area, this line that's been in since the pre-market, what do we expect this to turn into? This prior resistance area in the downtrend and this range. What should that line now become? We talked about this half an hour ago. We got started here, right? These swings that are support become resistance, and the resistance swings generally become support. So as we start to go forward, notice what starts to happen here. So here again, where are your entries? Where are your entries when a market that does this? Yeah, you're buying support. Again, the trend is up. You're buying support. And look at what came back into play right here. Remember we drew that all the way back here? Way back here. That was the overnight session, the pre-market session. Look at what the thing does. It's like a little magnet. Gary has entire webinars dedicated to this. If you haven't watched any, I really urge you to do it. They're very, very good, and we use them in the room all the time. He puts lines there all the time. If you're not using the lines, it's going to be extremely difficult to have some form and structure. In addition to our indicators, you've got to put support resistance lines right on your charts. It's going to change your trading forever. Really, seriously, it will. It makes a huge difference in how you see these markets and how they move. Now I'm going to shift gears. I'm going to come off of YM. I'm going to bring up another chart, and I'm going to look at NASDAQ in the afternoon or late morning trading session. All the equities kind of did this. Okay, here's later in the session on NASDAQ. Let me blow the chart up and show it to you real quick. And we're going to ask some questions, and I'm going to try to work quickly through this so I can get a crude oil chart up too before we wind up wrapping up here. All right, so here we were in a range, you know, more or less that kind of looked like this. I don't have a lot of time. I'm not going to get into what the range. Everybody sees this range, right? You were in a range over here. It broke down, you know, later in the morning. It broke down here. It took out support, came back up, you know, hugged the mid-band and sat here for a while. Then it pushed up through all these swings. Background turned green and the bars are blue. So I have a twofold question. The first question is this, where would you be looking beyond the right edge of this chart? I see your question, Kenneth. I'll circle back and answer that. Let me lob this out here for the team, and as you're pondering your answer and putting it in, then I'll circle back and answer your question, Kenneth. So hang tight. So we have this thrust move. If we were looking to enter the market, thinking ahead beyond the right edge of the chart, where would we be looking to get in? Would you be looking for a long or a short, and where would you be looking to take it? I'll give you 25 seconds, because many times that's about all the time you have. Sometimes you have a minute or two because markets stall out a little bit and there's more time, but I'll give you 25 seconds starting right now. Would you take a long or a short in this market, and where would you take it? Okay. So Kenneth's question, while those answers are coming in. When we are in a big move in a trending direction and it is a load the boat situation, do you start with a number of contracts and then takes profits as the price moves until the final close, or do you add and remove contracts? That's a good question, Kenneth. There's two types of styles on that. Gary is a big proponent of adding on. So he'll put a runner on you know, at an entry level, long or short, wherever he gets in, and then he'll peel some off, and then he'll add back in on the retraces. So that's one type of style. For me, I load it up in the beginning. I load the whole thing up, pretty much usually, and then I peel as it goes up. So for instance, in the room, you might hear something like, okay, you know, if oh, wait a minute, you can't even see these prices. Sorry about that. I'm like, you're trying to pick out where to get in and you can't even see the numbers. My apologies. Sorry about that. Is that better? Can you see the numbers now? Okay, I only see a few questions here. Are you getting long or short? You only got 15 seconds left. Are you getting long or short? And where are you getting in? There isn't a trade entry here, and try to call it out. I only see half a dozen answers here. The way that I do it is I'll generally go in with my full complement of what I'm going to do, okay, whatever that number is. And then as the market moves in my favor and it hits targets, I will peel them off on the thrusting part of the moves. As the market pulls back, I look for spaces to move the rest of my stops up to. So, okay, it hit a resistance area. I'm going to take some profits at 15 3/4. I'm going to roll my loose stops up to just under 10 3/4 on a close. Right? So that's what that is. Occasionally what I'll do is if I say, okay, put the tight stops in, so maybe you have a monster move and the thing's run like 60, 80 ticks and you're expecting a huge pullback, then I'm going to suck the tight, whatever's left gets sucked up real tight, right? And then once that's gone, then generally I'm probably close to my goal and not really trading too much more. Okay, good. So you're looking to get long. The trend has changed to up. We've broken these swings. The background is green, the bars are blue, and the mid-band and all the bands are stair-stepping up. So the first answer to the question is you're looking for long trade entries. Generally speaking, we want, and we've said this many, many times before, when we visualize trade entries, we want to think of an area around the mid-band. Mid-band in this case is located right here at 10 3/4, 11-ish. And so it could come down into here, just shy of it. It could come right to it, yes. And it could come a little bit deeper. So we have to be prepared for these three scenarios. So what I'm sharing with you is how I look at a chart. When I'm looking at a chart and I see a thrust move and I'm thinking to get long, in my head, I am looking, first thing I do is I locate the midband. And then I sort of mentally draw, you could actually draw a box if you wanted to, but I mentally draw a box around it. I go maybe a couple of 4, 5, 6 ticks above it, and I go a couple of 4, 5, 8 ticks below it, and I envision an area like that. So think of it this way. This is the sweet spot of where you want to get into a trade. So if and when this market pulls back into here somewhere and bounces, that's the key word, right? And bounces, we want to get long. So when you start looking at charts, maybe as early as tonight or tomorrow, I'd like to suggest for everyone to try that exercise. Think of it kind of like this way. Most of you know softball or baseball, right? You know the strike zone. Strike zone is up at the shoulders, the armpits. That's the top of it, right? When the pitcher's throwing a ball over the plate, yes? You got the home plates right here, so it defines the edges. And then the bottom is generally around the knees of the person who's batting. Softball, you know, there's ladies softball, there's baseball. So think of it from the knees to the shoulders is the strike zone, and that's our sweet spot, and the center of it's usually right around that midband. All right, so here we go. We hit double top up there at that 17. We pull back, we're pulling back. We're looking for an ABC type pattern, and we notice what happens right in here. What is happening right here? Where are these bars located? Right in here. Right there. Right there. Where are those bars? Where are they located? In relation to our, we drew this ahead of time. This was our mental strike zone, if you will, yes? This is our mental strike zone. Where are these bars? They're right in the middle of it. Now, It doesn't always happen perfectly like this. We all know that, right? Sometimes it's like this over here. Sometimes they go a little higher, right? Sometimes they go a little higher. Sometimes they go a little lower. So it's really healthy if you can develop this. It takes a little while to visualize the chart. And so when you hear comments in the room to the effect of, you know, if NASDAQ got down anywhere near 11 and bounced, I'd be looking to get long. So the terms anywhere around, if we were to blow that up and say, what does the terms anywhere around mean? What I'm saying, to be explicitly clear about it, is in my mind, I am thinking of an area above and below the midband as the sweet spot of trade entry. Has everybody got that? That's the terms around that area. That's explicitly what that means. That's how I am visualizing it. And so when the market kind of does this perfect little sort of A, B, C thrust down into the heart of the strike zone, this is the fastball coming right down the pike in the sweet spot. What are you going to do? Yeah, you're going to box it in. You're going to take it. Got filled probably long on that bar right there. If you used a line or ray tool, you know, you could have been filled over here quite possibly. Or if you drew it tighter, well, it's hard to say exactly where that one would have got in. That one definitely would have got long here. The box trader got in here. Didn't quite get to your scalper target, pulled back to the bottom of the box, bounced, and then the line or ray trader got long here. And of course, all of you see that your scalp target is this swing. We're going to fade that swing at 17 by at least 5 ticks. So our target's really here around 15, which you got scalper target right here. Yes, scalper target's right up in here. You got it. And then it turns, and you're going to turn it into a runner. There's your runner right there. Just run your stops up. You get your stop up to 2 ticks behind your entry, and then you trail. You're trailing it up, trailing it up, trailing it up. Might have nicked you there. If it didn't get you there, it definitely got you here. There was your runner. You only need 1 or 2 trades like this a day. And so, you know, at the end of every session, you hear terms like, please try not to overtrade. Don't give it all back to the market. Lock it down. Hit your goal. Stay green, nicely green. Turn off the machine. Those are all from many battle scars and years of experience of getting in there, fighting a good fight, making some money, and then handing it all right back to the market. The whole idea in long-term trading, if you want to be in this game a long time, you've got to get discipline. And when you hit your goals or you've hit a couple of good trades and you're up a few $100 and you're happy with yourself, go into sim and don't keep risking it. How do you choose which one to take in the zone? Well, we're looking for some kind of bounce, Ryan. So what would happen is in our little ABC pattern here, you know, you're looking for it to find some support. You know, sometimes it'll find support just above the midband. You know, it'll form a little box, or you get a little pattern, you get a little bounce up in here. And sometimes, you know, it goes a little deeper. Sometimes it'll go, you have to, you know, watch the price. Here, let's do a couple more. When you get these powerful uptrends, sometimes the retracements don't go all the way down to the midband. Here's a good example right here. Right? So that's why you got to think of it as a sweet spot. I mean, sometimes in powerful uptrends, you know, you're not going to get down to the midband. You're just not. You may catch those, you may not. You may not have even been stopped out from down here. You could have still been trailing your stop if you had a looser stop. Here's another one right here. There's another one right here. Here's a perfect one right here. Perfect one spends probably a better part of 3-4 minutes sitting right here. That's textbook right there. That's a textbook mid-band long entry right there. It comes right down into it. Right? Here's a sweet spot of opportunity right there. So literally, yeah, what I'm describing to you is how I'm physically actually looking at the chart, and visually what I'm doing is when you hear the numbers in the room, and what I'm doing with my live account is what I'm showing you right here. I'd say it's a very healthy way to look at retracements. You can look to the left. Yeah, that's a popular statement that Gary has. You can look to the left. You can draw support and resistance lines. There's different ways to see your sweet spot. You know, there's different methods you can have. You could have put lines on here like Gary does in the room. You know, you put some at the swings. Those are usually levels that we're calling out to either for targets or for stops or support or resistance areas. Okay, listen, I'm going to go ahead and wrap. I went a little bit over here. We do have a big game tonight.